name's Rob Crossingham. I'm a partner in the insurance team at Waitmans. I'm joined today by my colleague James Dennison, who's also a partner in our team. Today we're going to be looking at some of the overarching themes that arise for the insurance market in connection with the COVID crisis, and in particular looking at the situation through the governmental and regulatory lens. Some of the issues that we'll be looking at, the pros and cons of mandated cover, the US approach, and some of the comments that have been made by the regulators in the UK. So we thought we'd start by looking at the scale of the losses that we can expect to see from the COVID crisis, and to compare them with what's understood about the capacity in the London market, and also looking at some precedents, some recent examples of what we might previously have thought of as being very large catastrophic disasters, to see how they were quantified and the level of exposure that arose from those disasters. So taking the first real world and very recent example of the Australian bushfires in January 2020, which was something that was all over the press at the time, and everyone would have expected that to be probably one of the largest losses this year. Moody's assessed the total loss at $3 billion US. In terms of insurance exposure, it was widely reported in the insurance press to be an exposure, a claims exposure of £370 million, plus a further £1 billion worth of government support from the Australian government. But in terms of the insurance market's capacity to deal with that type of loss, Standard & Poor's commented, this type of catastrophic disaster is anticipated, and so allowances are made in insurers' budgeting and forecasting for profitability. So the indication with the Australian bushfires, high profile and high value though it was that this was a loss of a type that was entirely within the capacity of the insurance market, albeit with substantial support from the Australian government. James, I think you had some figures around Hurricane Katrina, which was another high profile and very large loss.
Yes, well, the overall damage caused by Katrina is in the region of $125 billion US. The total insured loss was in the region of $41 billion, so approximately £30 billion, substantially more than the Australian bushfires, but nonetheless managed by the insurance market in the US.
All right, so with those two fairly recent and high-profile examples in the background, let's look at the capacity. And the best figures we've got as to Lloyds of London capacity is the 2019 Lloyds annual report, which confirms that Lloyds has net resources, which increased last year by 8.6%, but it has net resources as things stand of 30.6 billion, and a solvency ratio of 238%. So all in all, well capitalized, secure, solvent. In terms of turnover, GWP in 2019 was 35.9 billion. Paid claims last year were 23 billion. And again, Lloyds, the messages that are coming from Lloyds, from its CEO, John Neal, are really that Lloyds is confident of its ability to meet the challenge before it in response to what he describes as the far-reaching impacts of COVID-19. Now, so we've looked at some specific losses, large losses, and we've looked at capacity of a large part of the London market, but albeit just the Lloyds capacity. Now let's think about how much COVID is costing in just the UK at the moment, looking at some of the figures that have emerged from the government's relief packages. Bearing in mind that a large part of the government's relief is constituted in the guarantee of commercial loans to private business, from banks to private businesses, it's true to say that those exposures may never come to pass for the government. So the net total package of additional spending appears to be, disregarding loans, guarantees and deferrals, appears to be £50 billion, which is 2.3% of GDP. The total including the exposure to guarantees, so if all of the loans go bad, looks like 250 billion. Already the exposure of the UK government is far more than the global financial crisis in 2008 to 2010. So the 50 billion net spending or net cost of these additional packages is already considerably in excess of the net total resources of Lloyds of London. That's the background.
Yep.
Turning now to the position with the UK regulators, I'll pass over to James to talk us through what the regulators and what the central government have said at the moment.
Yeah, well, before I get on to the regulators, it's probably worth pointing out as well that the ABI's figures concerning the entirety of the UK non-life insurance market, again, as with Lloyds, doesn't suggest that the total non-life market could deal with figures of the sort that you've described there, Rob. The total written premium for the entire UK non-life markets in the region of £90 billion. They're managing assets in the region of £140 billion worldwide. So if you were looking to cover losses in the region of £50 billion or more, just from that, obviously it's going to create significant difficulties in terms of capital adequacy going forward. So
yes,
the figures render it obviously unworkable.
But it's worth mentioning, isn't it, that the 50 billion that the government has spent would be, if hypothetically passed over to the insurance market, would be in excess or over the top of the business as usual exposure that the market would be expecting to suck up before the COVID crisis. So it's business as usual losses plus 50 billion.
Indeed, and those figures that I mentioned, 90 billion premium and 140 billion assets, that is the entire non-life UK market. So, as you say, this is in excess of all of that, and the figures just obviously don't stack up. So, as far as the UK governmental and regulatory response to this, the Prime Minister and Chancellor have indicated that the lockdown would trigger business interruption policies, but only where cover was available. And the market has already stated that in many cases, notwithstanding the fact that policies will provide for business interruption cover, that cover won't extend to losses arising out of the coronavirus outbreak. The FCA has circulated a Dear CEO letter which supports that perspective. So whilst a lot of UK businesses do have business interruption cover in place, it seems that for the most part, those policies won't provide cover for coronavirus losses. So in addition to the input from the government and the FCA, one might also have some consideration for the position of the Financial Services Compensation Scheme in this context. It sort of brings us back to what we were discussing earlier on concerning the capacity of the market to deal with risks of this magnitude. If, for example, the risk were to be handled by an insurance market that wasn't capable of dealing with it, with the result that insurers became insolvent, then policyholders might find themselves in a position where they have to pursue a claim for compensation to the FSCS. Now, while in principle policies will, the claims on the policies will be covered up to 90% of the total claim by the FSCS. The FSCS is funded by a levy on the industry, which for 2021 will be in the region of £635 million. So again, the figures that we're talking about there just pale into insignificance compared to the overall loss. So the prospect of being able to secure compensation in relation to a claim that hasn't been paid by an insurer that has become insolvent due to the burden of pandemic risk claims certainly wouldn't take the economy much further forwards. That leads us on to the big issue of, well, what do we do about all of this if the private insurance market isn't set up to deal with this sort of risk, which triggers across the board simultaneously and affects everybody at the same time. I think, Rob, you were going to talk about the ABI's response to this so far.
Yeah, thanks, James. So we've seen what the central government and the regulators have said about how the market should be reacting. Now, the ABI, for its part, representing the insurance market itself, has issued a number of statements, and in particular, some comments made by Hugh Evans of the ABI shortly after the lockdown took place. His view is really that any solution to pandemics such as this could not be purely market-based, but would have to be fundamentally a collaboration between insurers and central government. And in terms of the criticisms that this could be portrayed as a failure of the insurance market, he says it's reflective of the limitations on the market, or limitations of the market, given the scale and nature of the losses. So his first point is that the solution, if there is one, has to be a collaboration between insurers and the government. He also accepts that a return to the status quo, which appears to be characterized by 80% of businesses not having insurance for this type of eventuality. But he says a return to the status quo is undesirable, and he does anticipate that something will come into place to cover this type of situation going forwards. Just touching again on the capacity issues that James and I have been talking about, the ABI's position is that is really to compare the usual course of business claims with the scale of the pandemic risk that's eventuated with COVID. And Hugh Evans points to the 7.8 billion in what you might call everyday business claims last year, which the market paid and was well able to pay, he says, because these claims did not come from all businesses at the same time. The insurance model worked and the claims were paid. But he points out this is not what happens with pandemics, where every business gets affected at the very same time. So he goes on against that background to say that no insurance market in the world could offer pandemic cover on its own. And pandemic insurance on a wide scale is virtually impossible without government support, because the capital required by the market to make it work would be completely unaffordable for consumers. He points out that, by way of illustration, that the turnover for UK business in 2019 was 4.1 trillion, and UK business employed 27 million people. And with those numbers in mind, it's quite obvious that that is absolutely not something that could conceivably be sustained probably by any commercial organisation in the world. And so again, looking at what Mr. Evans says, absolutely the state is the insurer of last resort and should be here in this type of situation front and centre. In terms of what the solution might look like, the ABI refers to a number of precedents, which are referred to in the ABI documents as protective gap entities. And in particular, in the UK, Mr. Evans refers to Flood Re and Pool Re. In the US, the Californian Earthquake Authority. In France, something called the CRC, and the Earthquake Commission in New Zealand. James, I think you've seen reports of progress being made already in the UK with some of the existing protective gap entities.
Yes, well, my understanding is that there has been a steering group set up between the industry and Pool Re to look at how one might set up a fund to deal with pandemic risk going forwards. I mean, Pool Re certainly seems to be the more appropriate model for this. Hugh Evans has mentioned Flood Re as well. Flood Re obviously provides reinsurance in relation to flood risks, and it's funded by way of a charge of £250 on every policy that's reinsured by Flood Re. There's also an additional £180 million levy on UK home insurers. That, therefore, is entirely funded from the insurance industry and backed privately. But again, it's not it's not got the sort of backing that's required to cover the potential losses one might see in the context of a pandemic risk emerging. So Poorly, on the other hand, in relation to cover for terrorist incidents, is backed by the UK government via the retrocession agreement. That, as it stands, provides cover for £2.2 trillion worth of assets and businesses. I mean, it has an emergency fund standing at £6.5 billion, but the UK government provides unlimited backing for it. So this, it seems to me, is absolutely the right sort of model for a collaboration between the insurance industry and government to provide pandemic risk cover going forwards to manage these sorts of issues if they do arise in future. Although one assumes that our experience of coronavirus is going to result in some adjustments to preparedness and behaviours which might reduce those risks in the future in any event. So that, I think, is what the UK response looking ahead is likely to be. It does seem to be, in some respects, similar to what is going on in the US, although there are two lines running simultaneously there, both at a state level and at a federal level. As far as the state response is concerned, there's a few states at the moment have proposed bills in relation to mandated BI cover, which would take effect retrospectively. There's an example of that in Pennsylvania. That bill would require any insurance policy covering loss or damage to property, including the loss of use and occupancy and business interruption, to cover business interruption losses due to global virus transmission or pandemic, and would affect policies in force from the 6th of March 2020, which is the date on which a proclamation of disaster emergency was first declared in Pennsylvania in relation to coronavirus. Other states, including New Jersey and New York, seem to be taking a similar approach. The difficulty with that, of course, is that the policies that were in place on the 6th of March had been written without anticipating a risk such as coronavirus arising, which is obviously why one would need mandated cover in the first place. And the insurance industry in the US has pointed out that if this sort of legislation were to be passed and the insurers were required to pay out in relation to coronavirus business interruption claims, that it would swiftly lead to the insolvency of many insurers and going forwards would threaten the availability of any type of insurance at all. I have also seen some reports of state funding of or state reimbursement of sums paid out as a result of these result of mandated cover of this nature, but that doesn't seem to be applicable across the board. Well, that sort of thing does seem to be more similar to the federal model, which I think you've been having a closer look at, Rob.
Yeah, that's right. So on a federal level, there since the outbreak of the pandemic, well, only six or 8 weeks ago, there have been a number of outspoken proponents in the US at federal level of a new scheme, and what is now emerging is the Pandemic Risk Insurance Act, which is making its way through Congress and looks probably to be approved and passed into law. The proposal, as outlined in that bill, Pandemic Risk Insurance Bill, largely follows a very similar scheme called the Terrorist Risk Insurance Act, which was introduced in a federal level in the US in the aftermath of the 9/11 bombings. From a policy point of view in a federal level in the US, clearly the concern, again, as here, is that 80% of US businesses have no cover at all for pandemic. And the solution that's proposed in the Pandemic Risk Insurance Act is that a federal pandemic risk reinsurance program would be established, which would effectively be a shared public-private compensation scheme for business interruption arising from pandemic. The federal program, the reinsurance program, would back the Pandemic Risk Insurance Program, or PRIP, which would be largely analogous to the Terrorism Risk Insurance Program under the Terrorism Risk Insurance Act. And that would work broadly as follows: that the market of insurers working in a particular or operating in a particular business class would be able to, on a voluntary basis in this case, offer pandemic risk cover. If that cover was taken out, they would be expected to contribute to a pot which would be taken as premium for the federal pandemic risk reinsurance program. The scheme would be operated as a whole on an annual basis with effectively an annual aggregate deductible of $250 million. And once the scheme had paid out the $250 million, then the federal fund would pay out 95% of claims thereafter, up to a total annual cap of $500 billion. So as an example of the kind of collaboration between the commercial sector and central government that's envisaged, I think, probably by the UK central government, and certainly by the ABI in this country, what's happening in the US at the moment seems to be a tried and tested model. I mean, it's been in place since the Terrorism Insurance Act in 2001, and might well present a solution to the losses and the troubles, the financial troubles that we're facing at the moment. So that concludes, I think, our commentary and our thoughts from an overarching themes perspective of the government and regulatory view of what's going on and what the solutions might be.
Yes, thanks, Rob. I think, as with everything concerning coronavirus, the situation in terms of insurance market response to issues of this nature is very fast moving. It's good to see that the industry is responding robustly to it, and I don't doubt that a sensible and workable response will be forthcoming in due course. In the meantime, I hope that everybody listening to this podcast is managing through these extraordinary times without too much difficulty, and that everybody is staying safe and keeping well.